Let's begin. So welcome everyone to the Global Corporate Venturing webinar, which is on critical success factors in venture building, lessons from real world cases. And when I say real world, I do mean that we are going to talk about, genuine practice with three people who are extremely experienced in this. They have built multiple ventures. They are doing it. They are hands-on, and we'd like to invite you to ask plenty of questions. So if you are, involved in venture building at the moment, maybe stuck on a problem, maybe thinking about how to start, this is the time really to put those questions out there. Let me briefly introduce the panel, and then I'll just set up the session with a couple of facts and figures that we found from a survey that we did recently. But I'm actually really pleased to say that we're hosting this webinar in partnership with Alloy Partners. And we're really, really grateful for Alloy for supporting this, because it allows us to put on this kind of educational program, which I think is really important for teaching companies, or, there aren't many forums in which you get to learn how to do this. And I think for GCV, it's very important that we open up this space for dialogue. So we're really grateful for Elliot for supporting us on this. And we're really grateful that he's here, because Elliot, supports companies in building ventures that they intend to spin out of the company. He has a lot of practice in doing this, and will tell us why he's kind of come to the particular methodology that he has. We also have, on the other side of the coin, Tom Schneider, who was until recently with Schenker Ventures, with DBS Schenker, which was recently acquired by DSV. So now he's doing much of the same stuff that he was doing with Schenker Ventures, just under a different name. We're not going to talk too much about the DSV role as such, because it's still fairly early days. But Tom has been building ventures for years and years, and is really focused at this point on building ventures that will remain internal. So this is the different perspective. And last but not least, Paul Meyer, who has built ventures, I think it's fair to say, on both sides, internal, external. At the moment, though, has worked with Elliot in getting Atheon started. This is an animal health carbon capture type of funding proposition, which Paul will tell us about. It's kind of an external venture that is spun out, and there's good reasons for doing that. And Paul will tell us about why he's felt that that was the right model. So just to set up the session, I just wanted to share with you some of the findings that we had from a survey that we did this summer on venture building. What we did was we surveyed 100 or so companies who were engaged in venture building in some form. And what we wanted to do was just to get a sense of what the status quo was, and to see if we could begin to see any kind of hints at what best practice might be. And we found quite a number of things. You can go and find this webinar on the GCV website if you'd like to look at it further. But I'm just going to share a couple of things. One thing we found was that for the most part, venture building for companies is very much an internally focused activity. So the final destination of a lot of the ventures that are being built is not for them to be spun out to become completely independent entities, where the parent company only has maybe a minority share. It was the case in about 25% of cases, but it was much more common for them to remain integrated in some way. And then there were a variety of other sort of, turning it into an independent entity, but perhaps maintaining majority control, etc. And that's, I think, going to be one of the themes of this session, is that there is some confusion about how you should set up, ventures depending on what you're intending, their final destiny to be. And I think that's one of the things that if you can get this right from the start, you save yourself a lot of problems. The other thing that we kind of uncovered, which really surprised us, was how little use there was of any kind of financial upside for venture builders. So while we're trying to create, startup style innovation, there is very seldom startup style compensation attached to that. And it was doubly interesting, because when we asked venture builders what their biggest pain points were, by far the biggest one was staffing. So it's hard to find people to run these ventures, hard to find good people. And I don't think that these things are unrelated. And then finally, this one I think I'd love to hear, Elliot, Tom, and Paul speak to, but actually the lifetime investment cost of a venture to me seemed surprisingly low. I had always thought of building a venture as being quite um, a money pit for companies, that you would spend a lot, but actually for the vast majority of companies, they reported that their lifetime investment cost of venture was less than $1 million. And I think there's various reasons for it, which I think we can come to, because you either, you know, perhaps before you spend more than 1 million, you've already spun it out, so therefore you're getting some additional funding sources, or perhaps you're just good at killing them before that, or some other combination of things. But these were some of the findings, which we can get into. So I will pause there. And one thing that we'll also do as we get into this session is I think we have a poll, because I'd love to know kind of where the audience is in terms of your experiences with venture building. So are you engaged in venture building? Are you thinking about it? Are you not doing it? And then a second question on what your biggest challenges are. So I'll let that poll sort of run in the background as we get going with the discussion, but it will help us perhaps see where we should maybe focus the discussion. And also the other thing that I should say is please do use the Q&A function. So that's at the bottom of your screen. I'm sure everybody on this webinar is a very experienced Zoom user, so you'll know where that is. Do use the Q&A function to put questions to us, and we'll try to get to as many of those as we can, especially in the latter half of the webinar. But okay, so without further ado, I would like to bring in the panel. And I wonder whether we can start, as you come on, you can perhaps tell the audience a little bit more about what you're doing, because I've given only the briefest of introductions. But if we can start with you, Elliot, I just wonder whether you could start with this kind of central question of what do we mean by venture building, and whether, companies really are putting a lot of very different activities perhaps under this same title, and how we could maybe begin to kind of articulate differences between these.
Yeah, good question. And I think it's a really fundamental part of venture building, and I think it's a big reason why a lot of corporate venture building doesn't work, because we're not defining it appropriately and not defining the different types of venture building that a corporation might pursue. And this is based on almost 30 years now of doing corporate venture building in one form or another. Every different possible approach I've tried and seen some success, and with lots of different approaches. I think that the first thing a corporation needs to do, if corporation's going to pursue venture building, is determine what types of opportunities or ideas fit under the umbrella of venture building versus just something that the operating business is going to do as a new thing. When does it require a separate team, separate funding, separate governance, separate incentives? And then related to that, when does it belong as an internal venture inside the corporation, and when should it be spun out? When should it be an external venture? And in Ally Partners, we focus, as you mentioned, exclusively on external ventures, those types of ideas that might be a little more transformative, disruptive, hard to do inside the corporation. We'll do those outside the corporation as an independent startup. And we found that for certain types of ideas, going outside works really, really well. The main thing is to be deliberate about the choice. Often corporations find that they're doing some form of venture building without thinking through the range of possible approaches and what's right for different types of ideas.
Yeah. And what, just to stay on this briefly before we go to the others, but what kinds of ideas do you instantly see as being suitable more for the external approach?
Yeah, there's a number of questions we'll ask ourselves in the beginning, kind of triage up front when we're starting to look at an idea. Is this internal or external? And for us, it's not quite as simple as this, but we'll break it down into two broad kinds of problems or opportunities. Is it an execution challenge, or is it a learning challenge? Corporations are optimized for execution. They're really, really good at executing in a capital efficient way. So if you've got a problem where you know what the problem is, you know what you need to do, you just need to go do it. A corporation is going to be a startup all day long, and that should be probably done inside the operating business, even as an internal venture. On the other hand, if it's a learning problem where you know what the problem is, you're not quite sure how to proceed, it's ambiguous, You're not quite sure what the solution is going to be. It's going to require trying things and learning and likely making mistakes that are capital inefficient, by the way. A startup is going to beat a big corporation at those types of problems every day. Startups are really good at making mistakes. They're optimized for it. They're really good at being capital efficient and stumbling into those things that work. And that's okay because in a startup, you can be wrong a lot as long as when you're right, it really, really counts. And so you've got to set that both of those activities require completely different forms of governance, incentives, structure, talent, everything.
Yeah. Okay. So learning versus execution. I think that's a really interesting way to treasure. I'd love to turn that to you, Tom, and your experience, because you have built both external and internally focused ventures in your time, although now you're focused really on the internal ones. Do you think that kind of categorization, does that chime with you?
Yes, for 80% of the things that I've seen in the last 9 years, definitely, right? So what I learned from corporates is that they're a little bit blended by the unicorns that they read in the news, right? And they say now we have money, now we build our new unicorn, we now invest into one idea, and now it's going straight to unicorn state, right? And then we make a lot of money beside our core business. So that's what I learned a lot. But my feeling is that companies have a very hard time validating ideas before they throw a lot of money at it. And I believe, especially the early stages of venture building, learning what could be out there and what could be the leverage of the assets that, for example, we have in a company, but just in different context, is something that a corporate is not very good at, right? They are scared of addressing other customers with new products because they are scared of that the core business could suffer because of that. They are scared of using new technology because they are scared that their IT infrastructure could be infected by a bad player from the outside, right? So, and these are the things where corporates are a little bit hindering themselves and being more innovative, right? And I'm now coming from the European market and especially from the German market, right? We see that the Germans are a little bit lacking innovation power and startup power at the moment. And it's mainly because we were driven by a lot of big corporates in the automotive industry that are now through new technology a little bit overwritten on this side, right? So, and from my point of view, Elliot is spot on when we say execution, that's something that a corporate can do. Exploration, understanding an opportunity area and executing then later on it is something that is well in venture building environment. There's a third area that I would like to point a little bit out, and this is that corporates have a lot of assets that are not used today in the way they should be used and where a lot of business could be behind, right? Because people are not thinking in the way that, for example, this problem that I solved for the Asian market is something that could be interesting for all logistic companies and all over the world for every region. So why not taking this asset and understanding in the market with a new venture approach if it could really hit the point and if it could really scale up from a revenue point of view and from an asset point of view, right? So leveraging assets in the market is something that I really love to see and to do in the last 9 years of venture building.
And why is it that a lot of the things that you're working on, are destined to kind of stay within the company rather than being spin outs?
Yeah, that's a good question. So I worked on things that were intended to stay, and then we're seeing that in the markets there was, for example, a neutrality requirement from customers because they would like to share more data with us that they were hesitant to share with the company that I built for, right, for Schenker. So at this point we were 6 months, 7 months ahead, and the idea developed into something that should be scaled outside, right? But most of the times where I was really good and was at spotting the assets in the company, in the regions, in the systems, in the data, and then saying, hey, that's something where we could leverage information that today is not used to generate revenue and therefore create a new revenue stream, which is mainly a new business unit then, and really extending the way how we do business with an unfair advantage that is in assets, IT, or even in logistics like warehousing or brick and mortar business, right? So these are the things that then builds an unfair advantage, which makes you way faster from a go-to-market point of view, but maybe a little bit slower in the execution part because you face some impediments. But if the go-to-market is faster than having an external venture, maybe it's okay to compromise a little bit on the speed of execution at this point, right? So that's then the question mark that I would make.
Okay. Okay, great. And I think we can kind of continue to untangle some of those that decision-making process, but I'd love to bring you in now, Paul. Just you know, in terms of you have built again ventures that stayed inside the business, which I gather from some of the conversations we had before this webinar didn't always work out terribly well. So when you came to do Atheon as a business, it was partly that that business itself needed to have perhaps that kind of external, you know, approach because there's so many stakeholders in it. So maybe you could tell us a little bit about that kind of decision making and what you're doing now.
Thank you for the segue. I appreciate it. Look, I'd like to maybe just as a frame of reference. This is my third ground up startup, and so I've got lots of scars from building ventures either on my own or in partnership with a traditional venture studio, and so yeah, I think because of that experience, I think that what Elliot said at the beginning is really really describes best what the challenges are that you face as you launch a new venture. And that is, if you're trying to do something that hasn't been done before, you're trying to create a new category. Sometimes that's something that's best left to an external venture. And traditionally, a lot of the large corporates that I've worked for historically, uh, they don't necessarily have the incentive structure in place to effectively build a spin out. Um, we were fortunate in this case to meet Elliot and his team at Alloy, and they had essentially I came on board as an entrepreneur in residence for them after I built out my last startup. The concept behind what we've built today, we're Athian is a software company that essentially provides a way to fund on-farm practice changes in animal agriculture. So we work with dairy and beef producers primarily to fund greenhouse gas reduction projects. And those projects are really required by the end of the value chain. So large food companies are interested in this. If you're General Mills or Nestle, you've got these large commitments that you've made to your shareholders, and in some cases, it's regulated by statute. You've got these large scale commitments, and if you look at those companies, roughly 90% of their greenhouse gas footprint comes from their commodity suppliers. So it really requires some way to influence that supply chain, and they don't own the means of production. So as a software company, what we've done is we've effectively connected farmers to co-ops and processors and packers, and then to food companies, ultimately to food service providers as well as retailers. And that really was an infrastructure that didn't exist before. And the company that essentially sponsored the concept was Elanco Animal Health, the large, essentially worldwide provider of animal pharmaceuticals. They had new products coming down their development pipeline that only had a greenhouse gas reduction claim. And typically they sell products that enhance productivity. And so there's a clear return on investment. So if they couldn't find a way to incentivize farmers to be able to implement those practice changes, there's no way they could market those products. And so I think it was an ideal situation where Elanco had a vision of how do we go solve this problem. Alloy stepped in and helped to articulate what the market opportunity should look like. And then I came on board as an entrepreneur to find a creative way to build out essentially an arm's length platform that had credibility, that could serve as a go-between and really an industry convener to connect each step in the value chain to achieve that long-term result. So I think I believe a case study for how it really makes sense to pull all those providers in. And that's exactly what we did. So we had some initial seed capital from Elanco. We quickly went out and raised capital from other strategic investors that were early in the supply chain, companies like Tyson Ventures, um, uh, DSM Firmenich, large international animal pharmaceutical. And then now we've got additional investors that are playing from the end of the value chain, folks like Chipotle and Mondelez. So really, we've essentially built this funding structure that also has enabled us to go to market with them as go-to-market partners. And I think it would be very challenging to do that if you did it as an internal venture.
Yeah. No, and I think you've now got to a point where it's almost starting to look like any kind of startup in the sense that you have all these, stakeholders who are contributing to it. But I think what would be interesting, and maybe Elliot, this is where you could jump in, but those kind of that initial setup with Elanco, what was that conversation like with them when, the idea was just starting, it was what's in it for them to set it up in this way and put in the initial funding that they put in, because I'll also before so I'll share these results because this is quite interesting. But in terms of what people said as some of their biggest challenges were, lack of management support and funding came out as a one of those big pain points. So I'm just wondering if we stay with the Athian example, like how did you have those initial conversations there?
Yeah, it's not intuitive, right? That a corporation should be spawning new companies outside the corporation. You have to really sit down and think about it to understand why does that make sense. And the reason it makes sense is that corporations, in order to endure for a long time and be able to provide the benefit to society that they need to continue to learn. And corporations are not designed to learn, just to state it plainly. They're designed to execute. They're designed to preserve what already exists. And so as long as the world stays just as it is, corporations going to continue to crush it. But the world changes all the time, and corporations are really not designed to learn and adapt, especially when there are things that might challenge the status quo, that might even compete with the existing business. Corporations are designed to push those things away and reject them. And so if a corporation needs to learn, you have to set up the structures to be able to do that. And like I was saying earlier, startups are really good at learning. They're really good at learning. And so if you can somehow as a corporation figure out a way to set up a structure that enables and incentivizes that learning, then that can work really well for the corporation. The trick in building these startups is to make sure that the learning is coming back from the startups into the corporation somehow. And we do that in our model by designing startups from the get-go that are trying to solve or address some type of problem or opportunity the corporation sees that needs to learn about. In the case of Elanco, that was the sense there too. And with most of the corporations we work with, yes, there's financial return in terms of the direct investment that goes into the startups. The more important form of return is the strategic return that comes back from these startups that are spun up, that are purpose-built to address some type of strategic challenge or opportunity that the corporation is not set up to go after.
Yeah.
Yeah, if I could weigh in just for a second. It was incredibly valuable when we launched this company. And as I mentioned previously, I've got the scars from previous ventures, especially working with strategic partners, that it was incredibly valuable to have Alloy as a third party who set the expectations early on with our venture partners, with these strategic partners, that this was going to be an exercise in sort of an arm's length building process. And oftentimes for a startup, it can appear to be self-serving for me to go to my venture partner and say, look, we need more equity to share with the type of people we need to bring in to build this venture. We need to set up a legal structure that enables us to be entrepreneurs, but still provide a return to you as an investor. And if they are if they keep their fingers in the pie too much in that process, it prevents me as a startup CEO from being successful. And having a third party that is advocating for both sides was incredibly valuable, especially in the legal structure that we set up initially. As it turns out, we're 3.5 years into that structure today, and I'm able to raise capital because of that structure. And in previous ventures, by the time I got to Series A, I no longer had a capital structure that would enable me to attract additional investors.
And I remember, Paul, you saying it in your case, you felt it, you very strongly wanted to have that entrepreneur profile of person. I mean, you are personally that, but also I guess the people that you're bringing on board, because there is a material difference in how these people, will work, how hard they will, go for things. I guess you need a profile of somebody who's good at working in uncertainty. I don't know, all of those entrepreneur tropes, right? But they're true to some extent.
Yeah, yeah, 100%. And I was we had a great idea when we started this company, but it was truly bringing in the right team to execute against that original vision. And we've pivoted in maybe small ways along the way, but it's really based on the strength of the team that we brought to solve this problem. I mean, we identified early on that we essentially needed some fintech expertise to build out what is ultimately a sustainability platform, but that's not intuitive from the get-go. And so we were able to recruit some folks that have done fintech startups previously, and they've added tremendous value to the organization and to the long-term execution plan for the company.
Yeah. Okay, and the reason I've kind of wanted you to articulate that is because, I mean, we had a great question, which I think Tom has partly answered as well, from Alice Coe. But this is always what gets asked about, the company mindset, corporate people's mindset. Everybody always says that these, whether it's an internal venture or an externally minded venture, it's about the learning, right? And then, so how do we, if we do want this also to have some sort of transformative effect on the company, how do we do this? I mean, because one way is, yes, you bring in a lot of external people. What if you don't have the luxury of doing that? And here's where I'm going to turn to Tom, because if you're keeping stuff within the company and you're working with the people who are probably from the internal company and might stay there, and how do you resolve those staffing issues?
That's a very good question, because initially when we set up Schenker Ventures, we only hired people that already founded something by themselves, right? So the venture architects were the ones that already founded something by themselves out there for another company and were able to show traction. Why? Because you think differently within a corporate when you are responsible for the business of P&L responsibility, right? So what we tried several things out. We tried out idea sprints. We tried out having people on board. But what we ultimately learned is that most of the people, especially when they're bound to business and to operational tasks, they are good subject matter experts for a time where you need the subject matter expertise, but they are not that good executors in a startup environment, right? So there's nobody sitting there trying to automate the invoicing process, because it takes a lot of time from the founders that are 2 or 3 at the beginning, and they need the time to, for example, explore the next idea or talk to customers or close the business. In a corporate, you don't find a profile normally that sit there on a Friday evening at 9 p.m. And call people from a cold calling list of 2,000, 3,000 people, because you need to close the next deal of 10K, 20K next week on Monday, right? So you're not incentivized in a corporate to do that, and most of the people already have a job when they should be part of a venture. And at the point where so a lot of people jump the ship when they feel like, hey, that's great because startups are cool and it's something that's nice for my CV. But when then it's getting really hard, and you're talking about, okay, but your salary will be 50% of what you're expecting today, but you will get shares of something that today is not valuable that much, but might be valuable in the future. A lot of people jumped the ship, to be honest. So they just left the projects and the ventures that we did. And then we staffed the ventures with external people, mainly a lot of people that are good in growth, right? We incentivize them by the more money, the more revenue you bring, the more money you get, right? So that's how we did the things initially. And we had the corporates always have very often have a good trainee program where they basically put on young high runners that are a little bit more junior, but that really want to run a lot, right? And this is where I scouted a lot of good tech people that had a good tech knowledge of what is needed today, had the interest to really execute on it. And I have one tech lead sourced from internally that had this entrepreneurial mindset because he founded something by himself beside the corporate. And he is guiding these people from a seniority level, right? So I basically set up my own structure internally that I always have a good growth lead, a good tech lead. And then we are basically educating our own young people from the trainee program straight into the entrepreneurship. So they are not in a standard corporate job that is paying a lot of salary, but it's basically a golden cage.
Okay, so external people seems to be
Yes.
the answer in both cases. Okay, so we're starting to get quite a lot of good questions in. And so what I would say is, if you have a question, please do use the the Q&A function. And I think there was one question which I think you're already starting to answer, Elliot, but perhaps we can answer on the session. But it was about specifically ownership structures for external ventures, and I think this is something you will have thought about a lot. So what's the model that you recommend, and are there some variants on that based on what people need?
Yeah, it is a model we've thought about a lot, and learned a lot about, both through good things and mistakes along the way. The thing about the ownership structure is what I tell corporate leaders all the time is often when you're thinking about building ventures as a corporate, you're trying to replicate as close as possible to what exists in the VC world, right? You look at what VCs do, venture-backed startups. We've got this amazing ecosystem of incentives and governance that has been refined by the market and works really, really well for building startups and go out and discover a secret and scale quickly. And so when we're thinking about as corporate leaders looking at that and what success can come from it, we think, oh, it'd be great to do as close to that as we could. But there's certain things we can't maybe replicate in a corporation. My answer is absolutely not. You don't have to try and copy or get as close. You can do the exact thing. So you've got this model with venture-backed startups has been honed over decades. It works really, really well. Just do that exact thing. And the way we do that when we think about ownership structures in these external startups, it depends on a few variables. How much capital is required at the launch? Who is going to continue to invest capital in a startup? Like just a quick aside on that, if this is going to be a $1 billion success story one day, that may require $1 billion in capital investment to get to a company that can generate $1 billion in revenue, right? And so the good case story as a corporation spinning something out, if this is successful, are you going to put in $1 billion over the next few years into this thing? That's highly unlikely. So you need to think through good case and bad case. So will you need other investors down the road? And then what's required to recruit and incentivize really good entrepreneurs? And we found that in the situations, what we're doing most often is we're building startups where we want to retain optionality for other investors to come in. So the cap tables need to be designed to attract tier one VCs in 12, 18, 24 months, or in the case of Paul, other strategic investors who want to come in.
And
so
there's a very definite limit also and what you think a company should then own in order to make that cap table attractive?
There is, and it's been defined by the market, not us. I wish it were not the case in some cases, but what VCs have told us is that they will squint and invest in a company if the CEO and the founding team, the rest of future employees own at least 60% at the seed or first round of capital. If a corporation, what that means is if a corporation owns more than 15 to 20% in these companies, other investors aren't going to come in. That is sometimes really hard news because corporations saying we put in the initial capital, we help generate the idea. You're telling me we can't own more than 20%, to which my answer is, yeah, because you're trying to optimize for learning. If you take a minority stake in these businesses and spin them out, they have strategic and financial freedom to go figure things out. Financial freedom, meaning they can go raise money from other investors who can help and provide another perspective. You can still invest all the capital later if you want, but you've retained optionality, number one. Number two, on the strategic side, if you own too much as the corporation, well, guess what? You're going to have to consolidate balance sheet. And yeah, you're going to need the startup to use your HR practices. And, we've got a corporate attorney. Can you just use that? Pretty soon, the thing dies a bunch of a death by 1,000 cuts. So you want minority stakes so this thing is not strategically constrained, meaning they can go in the market and have the freedom to learn what works so that you can be surprised. That is the biggest form of return a corporation is going to get from these ventures.
Okay, so surprise is the thing you're optimizing for, which is, again, not a necessarily an intuitive thing for companies who usually don't like surprises. But
Yep.
it's Tom, you were nodding violently there when Elliot was talking about the cap table. Is that your experience also of in the kind of European and German context?
Yeah, so from a Schenker Ventures point of view, right, we did three things. We did internal venture building, we had a venture studio with minority shares, and we were doing venture capital, right? So these were the three main areas that we set up basically parallelly. From an internal venture point of view, I nodded because we had exactly the issue, right? So there's a corporate that's getting greedy as soon as they see that the idea could work. And then they basically ask you to create a plan how to scale this. Then you create a plan to scale that based on all the numbers and information that you derive from the markets. And then they're thinking about, oh, if I have to invest this in the next 5 years, then I'm basically putting 30-40% of my profit into this idea. I don't want to do this anymore, right? So, and then you're at the point where you could scale. You are an internal venture. You don't have the opportunity to spin it out, so you're not attractive for external investment, and you're slightly dying out, or you are rather not exponentially but gradually growing, right? So that's an issue. The greed is always bigger than the commitment that the corporate will do for such an idea if you really want to support a growth trajectory. So that's my understanding. The second topic that we learned from a venture studio point of view, that's exactly what the corporate thinks, right? They say, we support the idea initially, we'll let them run, and then as soon, we basically did like this. First, a little bit of money, we got a small share of the company, right? So, and then the next step was that the company or the venture finds themselves some investors so they can move on. So that was the idea. What we have seen in the market is that there is a lot of demand in the European VC market that I saw and I heard of, that investors don't like to see corporate on the cap table overall, because they know they are slow and the decision structures are a little bit annoying to them a lot of times. And they're always scared a little bit of a corporate pulling out. The interesting thing there is that the studios that were invested with VCs in, they always demanded, let's create a test environment. Let's use your network. Let's spread it out, right? So, and the next time when startups went down, there were contractual things that the corporate didn't know of, that they were basically, it was very hard to invest further, and then the corporate was basically pushed out, right? So there are things in the market that we see, and I know why, don't like corporates on the cap table, and corporates on their side look at this and say, when nobody wants me on the cap table, why should I then invest and open my network for the ventures to grow initially and to learn within my network if I don't get anything out of it at the end, right? So, and this was the European experience that I had with my small view on the things that I've seen in the last 9 years, right?
I think there's been kind of a, it's fair to say there's been, lots of poor practice on both sides. I wonder, Paul, with your kind of background of having, corporates on the cap table, do you think, and I don't know whether, do you think we are evolving, and, are some of the more practiced corporates kind of negotiating this better? And, I mean, obviously all your shareholders are great people and wonderful companies, right? But,
Yeah, look, as I mentioned, I've got some scars from previous studio startups, and specifically my last venture, we ended up, I was interested in the chart you shared when we started this conversation, that a lot of these ventures end up getting spun back in, like more than 40%. That was a higher percentage than I would have imagined, but I can certainly see through my experience. The last venture that I worked on, we ended up essentially selling it back to the strategic investors, and they pulled it back into those organizations. It didn't grow at nearly the rate that we had been forecasting, but there were some. I mean, look, there's always business imperatives that drive some of those decisions, but I can see clearly now with this venture, because the expectations were set up front about what that ongoing investment should look like. It made the process much easier. And when I was also looking at the chart that you shared, and the initial investment by our partner was at $1 million, and the initial idea for the product and service that we were going to bring to market didn't require much more than that. And it was, as we went through the validation process, we identified that there wasn't really a market for these Scope 3 supply chain credits. It didn't really exist. And that without that marketplace, there was not going to be an efficient way to essentially drive capital back to the farm. And so we retooled our vision and said, look, we need to go raise, instead of 1 million, we need to go raise 5 million, and we need to go to strategics to get there so that we have credibility in the marketplace. And fortunately, our partner was amenable to that, because there was executive level commitment that said, we want this to be successful. We realize we can't do this by ourselves, because it needs to be a credible platform going forward. And so we were able to go and make that pivot and still had a legal structure and a capital structure that would support our ability to go out and raise additional capital.
Yeah, yeah, you've been set up to look to all intents and purposes like any startup. So, but I'm going to change tack a little bit because there was another really good question about de-risking, which I think would be really very interesting for this. And I think, one of the whole points of doing a corporate venture is that there are, these corporate strengths that you can draw on. So I would love to ask all of you about kind of your, thoughts, strategies, any really good tips about how you kind of leverage the corporate angle to de-risk what you're doing. And maybe, I'll turn it to you, Elliot, to start with.
Yeah, we think about as venture builders, our fundamental thesis is that we can build what we call advantaged startups by doing it in partnership with corporations. And that means that the corporation endows the startup with some form of advantage that would be hard for others in the market to replicate. Sometimes that means the corporation is the first customer of the startup, maybe a distribution partner, maybe even just a bestower of credibility in a market. All kinds of ways a corporation can jump in and provide advantage. And over time for us doing this, we've got a pretty high bar for what that means. We get to the end of a business design process. If we can't articulate what the advantage is, we don't launch the company because a startup launched this way, just to be really clear, a startup launched out of a venture studio period, I believe, or launched this way, a corporation is in some ways disadvantaged relative to your standard startup. The cap table might look weird. The team maybe didn't generate the idea. They're coming in to operate. There are some challenges. So you've got to find ways to inject advantage to overcome those hindrances so the thing can move faster. And when you do it right, these startups can move much, much faster than
So how much advantage do you have to be able to articulate? I mean, is it enough to say, oh, well, we've got some market access because, we're in this business, or like what does it need to really be?
Yeah, it totally depends on the nature of the startups and the nature of the corporations that we're working with. We've got classic examples. Launching startups in healthcare is notoriously difficult if you're trying to sell into health systems. But if you can build a startup where a health system before the launch decision has already agreed to be a customer, in fact, you've already negotiated the contract, ideally, and that health system is an investor in the startup and they're motivated to see that startup succeed, well, that startup's going to begin with immediate traction. In healthcare, as an example, the funding cycles are often longer than the sales cycles are often longer than the funding cycles, right? That doesn't work in venture-backed startups. So this is a way to circumvent that and get these startups moving faster.
Okay. All right. Great example on that. What about you, Tom? In what ways do you kind of try to build that advantage?
So when we talk about advantage, I could tell a bit about my startup Nextlog, right? So Nextlog is basically leveraging clean transport data from the systems of Schenker in the past and now ideally DSV, and basically cleans up the whole transport and network-based emissions of companies, even when they have bad data, right? So that's the first step. And the second thing is that a lot of companies out there don't know their supply chains and don't know the transport networks and what is possible there. And how you could reduce emissions there. So we basically created a lot of simulation engines based on our operational logistics data, what the impact of, for example, a leverage of a wheat truck or a carrier switch from carrier A to carrier B could look like from a freight rate point of view, a lead time point of view, and an emission point of view, right? So we trained our algorithms with the data that we already had access to. So our algorithms were already informed when we went out there. Especially if you have data-driven models and you are a startup that first needs to get the first customers in order to get data and then train the models, you have a very hard time getting there, right? Because the first 3 or 5 companies get not that good quality, but have to share a lot. And that's a challenge in the go-to-market. So we had already a model trained on millions of data. So we were able to show them what the impact is without them investing a lot of time sharing the data with us. The second topic that we were able to do, right, we have access to worldwide request for quotation contracts and information, right? So we know what logistics companies all over the world and what shippers all over the world request in the next 5 years. So we see strategic shifts in the market and what they expect from their suppliers to act on. And that's something where we can already understand what our ideal customer profile would be targeting and who are the people that we want to attract. So we have way more market intelligence going out there at the beginning instead of reaching out there and going with an ICP assumption that is very broad, right? So we derive a lot of knowledge in order to start better and basically through knowledge get 2 years of go-to-market experiments already clustered into a few weeks and months of data analysis and using information that we already have within the big corporates and companies.
Okay, yeah, I think a pretty concrete example. And Paul, maybe, again, I think you've already sort of talked a little bit about the advantage you have in kind of being able to build this phenomenal network and the supply chain. But I'm just wondering whether there were any other kind of specific things that you could, you pulled on as you were starting this that maybe helped you go a little faster than you might have done had you been completely independently startup.
Yeah, it's a great question. I think that there are some categories that move fairly slowly, and I believe agriculture in general has been slow to adopt technology. And so for us to really make an impact, we had to partner with trusted advisors that farmers essentially had confidence in. And Elanco gave us a great start because they had a good working relationship with farmers. And they actually made some introductions that helped us to secure our initial seed investors. And then we were able to leverage that credibility and to bring in additional partners that they didn't hold sway with, that they didn't have that same kind of relationship with, but who on the front end of the value chain were an important part of our go-to-market. That is, it's the end of the value chain that ultimately are our customers. And we wouldn't have had the opportunity to engage with them at all if it weren't for the strength of the partnerships that we built initially. Clearly that's something that would have been difficult for for Elanco to do on their own. And because we had that sort of arm's length relationship with them, it enabled us to be able to leverage that to really bring out a much more holistic approach, not just to fundraising, but to execute on the end of the process, which is ultimately you've got to have capital coming in from customers if you want this to be a viable business.
Yeah. Okay. No. I mean, it's all those kind of, maybe getting into rooms and relationships that would otherwise have just taken so much longer. So that seems to be the common thread. And I have another, there's another really good question. The audience is really holding our feet to the fire and they're not letting us get off easy on this, which is there is a question around specific, success stories, and asking about, dollar terms and not just learning. So I would love to put this question to all three of you. What does success really look like, and how, and if you can quantify that in a financial way, what should people's expectations be? Because I think that it is a fair point that sometimes maybe expectations around this are a little bit soft, and that's why the planning gets a little bit off kilter. So Elliot, you've looked at a lot of these. This is a high level question you must grapple with every day. So what do you say?
Yeah, expectations should not be soft. In most cases, expectations should be far, far stricter than they are, far harder than they are. And I think the most underused and unheralded metric for corporate innovation is the extent to which outside investors are clamoring to put dollars into the things that you're building. And the reason why I think that's an important metric, it's rarely used, but it is the most important telling metric, because what that implies is that a corporation is taking a stance that enables other people to put a value on the knowledge, the secrets that you were discovering through these ventures, right? If you think about at its core, what a VC does when they go to invest in a startup, they're saying this startup has uncovered a secret, and that secret might be a way of distributing, a way of sourcing a product cheaper than somebody else, whatever it might be. Every Peter Thiel, famous quote, every good startup has a secret. VCs put a dollar value on that secret, assuming it's going to result in a future cash flow. And so if you can create your innovation structure, have it operate in a way where you are open to receiving that input from the market, it's the market telling you what these things are worth. Now, to date, our startups we built with corporations have raised over, I think, somewhere north of $70 million, something like that. That is a sign the market is saying we're assigning a value to what you've discovered. It's important for a corporation that is building new things. I remember working with a corporation one year where they'd had over $30 billion in windfall profits the year before. No matter what venture we built and what type of financial return they got from any of those ventures, it's not going to compare to the profits the corporation's already making. And so the important thing to remember is, yes, there's a financial return. That financial return can be substantial, but in the scheme of a large corporation, it probably doesn't matter a lot. What's far more important is the learning, and this sounds squishy, but it's not. It's the learning that comes from the startup that gets deployed back into the corporation to do new things, like open up new markets, drive more efficiency, increase revenue in different ways. Or in the case of, I think of Paul with Athian and the companies that have invested in him, opening up whole new distribution channels for products that didn't exist before, new relationships with customers. You can put a dollar value on that, and it's substantially more than the dollar value that will return to those investors from having helped to get the startup going. So it's the indirect that matters more.
Yeah, but can I ask, like, how strict are companies at evaluating that? Because if that is not happening, if you get somewhere down the line in building this and those things are not happening, I'm wondering whether then, because that should be a sign that maybe you're not on the right track. You either need to pivot or stop. And are they? I mean, are they able to kind of?
No, I mean, I think this is one of the benefits of doing external venture building. What we say is, look, my experience, when you're building new ventures, a lot of that activity is internal, what you're doing is you're funding that activity as an operating activity. And the money that you're spending on those activities are competing with things like marketing spend where there's a really clear defined ROI. And what happens is you get in these situations where the venture may not be producing the returns you want yet, and there's a question, should we continue to invest in it? The CFO is saying, this feels so uncertain, it feels like a bottomless pit. Here I can put this money into marketing over here, and I know what that's going to do in the next 12 months. Over time, the innovation team is always going to lose those arguments over time on average. In external venture building, what you can say to the CFO is, look, by creating external structures, you can invest in this from the balance sheet. Now we're comparing this opportunity against things like M&A or building a new factory or warehouse, more patient capital. And number two, you can tell the CFO, look, we're going to put $1 million into this thing, and that is all we're ever going to ask you for. After that, we're going to let the market decide if this thing should continue to exist or not. And by putting this out there, the corporation puts in $1 million. Now the startup has to go find external investors to keep it alive if that's what was required. And the market will tell the corporation whether you were right or not. And that's really, really valuable feedback. And it's a lot easier to plan around if you're the CFO.
Yeah. Yeah, no, CFOs must like the external ones. But what about, I mean, Tom, if you're, if the internal innovators are always going to lose the arguments with, marketing, how do you manage that? And what kind of return, I suppose, on your projects do you hold yourself up to in order to, to be proving you're providing value?
Yeah, I try to get as fast to revenue as possible, so I'm not dependent anymore on the corporate money. So that's what I'm always trying to do, right? And an idea is not validated until a customer or ICP that you have defined have not put money on the table. Even if they listen to you and sometimes they say it's a great idea, if they don't pay for it, it's not a great idea, right? So and that's how we evaluate. Or I nudged my teams to evaluate if the idea is good or not.
But yeah, so go on.
Yeah, there's an additional point to the internal ventures, right? And I can make it, I think, yeah, I can give this example. If you look at how a logistic service company is providing services to the customers, right? It's like, hey, you want to go from Frankfurt to Shanghai, it costs you X euros for 1 kilogram of freight transport, right? So that's how it works. And what we learned is, beside the extra revenue that we could create with something like Nextdoc, right, we could create crazy analysis on what would be the best sustainable option. And sustainability could be priced with a premium in front of the customers. Because what they basically tell the shippers is, you have now the opportunity to invest into a carrier switch that costs a little bit more from a freight point of view, but you don't have to invest into sustainable air fuel afterwards, or in 3 years or in 5 years, you don't have to pay the fines. Which means if you now invest, you sustainably invest and don't have to pay off your soul every year and every second year, right? So that's what they now have as an improvement in the RFP and offering process, which led to a lot more business awarded to a company. And we're talking about 10,000 of tons of goods, right, where you pay per kilogram transported. So if you could show that we can increase the volume that is given to a Schenker or to a DSV offering, just by having a better data analysis through a product that we have created that is for sure creating revenue, but is doing some other knowledge sharing to the corporate, then 20% on such a tender could mean millions of euros, right? And that's something where additional value and revenue is added to. One disclaimer: it's very hard to measure that, right?
I was going to ask if it was easy to show that incremental sort of revenue.
Yes,
I suppose.
it's hard.
Any tips for how you do that? I mean, can you ask, can you work with business units to help, get them to help you validate that, or?
Yeah, we're working with key account managers and salespeople, and if we incentivize them on the business they have sold with the help of Nextlog, and the bonus is based on this revenue, we exactly know how much revenue is done because the bonus is based on that, right? So and this is something that how we could use incentivization to have a better analytics approach afterwards.
Yeah. Okay. And just, one quick follow-up, because we are almost out of time. But I mean, when a project isn't getting to revenue quickly, I mean, do you just drop that quite quickly? I mean, what's your methodology for sort of just saying, right, that's it, we stop here?
It's the sellers we say you get this money to achieve these goals. Then there's one option to argue with data and with information, maybe even with customer feedback. For example, during COVID or during Christmas time, it's very hard to take decisions, and then they sign to like order next month or the month after. But as soon as we are not managing to get our revenue or growth numbers done, then we're cutting the business.
Yeah.
Then we're not doing it anymore.
Okay. And Paul, I mean, we're really almost out of time, but I just wondered whether you had final thoughts on how, how high a standard did you hold, Athian up at the start in terms of achieving those milestones?
Yeah, and I think Tom hit the nail on the head that you get to that inflection point. The ultimate validation is revenue, and when you're right on the cusp of revenue, we've had near-death experiences as entrepreneurs, and we've had that same lack of confidence from a strategic investor who could panic and say, "Gee, I want to just bring this all in-house and solve that problem." And you have to get over that hump. Once you get over the hump, then I think it can align. But being able to establish upfront what the criteria are for success is going to be key over the long term. And if you can remind your investors, look, this is what we agreed to when we launched the company and launched the business. We are right on the cusp of revenue. Once you get to revenue, then that validation and that conversation, it falls into the background, right? It's been asked and answered, but you've got to have that commitment up front.
Okay, and I am sorry to do this because I feel like we had so many questions. We could have kept going for another hour, but we are at the end of the time. So apologies if we didn't get to all the questions, but they will be fodder for future webinars. We're going to keep doing these because I think there's a lot to mine here. I am going to just show a couple of slides on things that we have coming up. I'm also going to say a really big thank you to all the panels. So Elliot, Tom, Paul, thank you for sharing that. I think we got fairly specific. I think we could have, there's a lot more we can dig through this, but learnings that I took from it is really articulating very early on, what is it? Is it a learning or an execution problem? You then, you have those conversations very early with the company about, really trying to bring them to this idea that they really have to have a limited stake in the cap table if they want this to be an external venture. Probably you need, an external workforce. I mean, everybody seemed to be in, agreement on that sort of entrepreneurial spirit is, you can be lucky and find it internally, but most often it's going to come from outside. And then I think this final point, I think was really useful of just how you really have to kind of get your KPIs to be pretty exact and strong and demanding. And just because it's an internal venture doesn't mean that, you know, you kind of get to be fuzzy around the edges. It's the same. Otherwise, it's going to take you down a road of disappointment, I think. So, but we will, you know, pull some of this together in a write-up as well, and share that with everyone. And so so a very, very big thank you again, Paul, Tom, Elliot. Just in terms of other GCV events that are coming up, we do have a series of meetups and conferences. So here's just a quick list of things that are coming up in the next few months. You know, if you we run a series of kind of professional development courses as well. So these are some of those: landing the value of corporate venturing, you know, CVC investment programs, and yes, these are some of the the conferences that are coming up. And the other thing just to say is we would really like your feedback. So we will be emailing after this session and asking you just to you know, give us some thoughts on how we can make these webinars even better and smoother, whether it's that you want more time, more charts, you know, more Q&A opportunities. Just tell us. We're trying to make these as useful as we possibly can. Thank you, everyone, for staying with us for the whole session. Thanks again to the panelists, and do come back. We will be running another webinar next month. I don't have the topic for you just yet, but it will be, you know, on CVC practice, and we'll be letting you know what that is very soon.